All right. Hello, everyone. So we have a very, very tight deadline for this panel at 11:15. So we're going to be as crisp as possible. Normally panels tend to extend, and I usually love to have audience Q&A, but not sure if we can have that this time. Nonetheless, if you think about the topic of this panel, global headwinds versus the India decade, this has been the topic of almost every single mutual fund presentation for the past 10 years. Second slide number 2 is global headwinds in glorious 10 years for India, notwithstanding any data to the contrary. And the reason for this is simple, because by and large our financial system has not been allowed to offer global exposure and diversification. So there's only one thing to sell, so you sell that. But the good news is that is changing. That is changing with Gift City. That is changing in multiple other ways. Our budgets have streamlined things. So on that note, I'm going to ask the panel, if you were an alien in space, if you were not Indian, how would you allocate your money across the world? I'm going to start with you, Andrew, and then move towards me.
I mean, I know a lot of the data for India, but let me just start by saying, if I was looking at India as my asset allocation, if I look from, I think, the 80s all the way through every year at the Sensex, each and every year you have a drawdown of anywhere between 15 to 20%. The last few years it's been a little less, 10 to 12, but if you look at the end result for each and every year, you, apart from 7 years out of those 30 odd years, or just 40 years I've mentioned, you would have made money, and you had made consistent compound growth of 13 to 15%, depending on when you decided to invest. So if I look at that, that's got to be one of the best performing across the world over that kind of time period. So I would put quite a lot of large allocation to India, and then I'd really think about what I needed outside of India in terms of asset allocation, and I'd be worried about the US for many different reasons, but that would be.
Could we get some numbers, Andrew? If you had to put numbers to it in percent.
So if I had to invest, it'd be 70 to 80% India, 20% Europe and emerging markets around Europe, and 10% US.
So my challenge is I'm not really a listed market investor. So let me actually start by, but I have been investing for 25 years, and if I look at my 25-year journny, especially. We just heard Anant Naran talking about the AIF ecosystem. I come from the VCF ecosystem transition to AIF, so I've seen the whole journey. In the unlisted space, and while the AIF is booming, I am always a more cautious guy. We started seeing return of money only very recently. So those who are investing in AIF thinking they are going to get 35% returns, need to be brutally honest with the performance and the reality. Most of us started seeing exits only as late as 2017-18, despite being long investors. And of course, we have been very lucky, and that's why you have your FDI numbers or FPI numbers actually balancing out in terms of international investment. So those who invested long term are actually exiting right now. So instead of creating capital formation taking place within India, it's actually liquidating old assets. And that's why you have even Anant Nageshwaran, the CEA, actually mentioning it in his annual report. So if I am actually an outsider and I'm putting in dollar capital, so let's assume some international capital which will have an exchange rate, India has 3.7 odd % of annualized depreciation over the last 30 years, but the fluctuations that are taking place, so depending on my horizon of investment, I have to take a 3.5% depreciation, but if my horizon is short, then I'll go short on India, partly because the volatility is very high and will continue probably for some time given the geopolitics that is there. And so I would...
Do you mean underweight India or like short?
Underweight on India. Especially in the short, if I'm investing for short term, I'll go underweight on India. Especially if I have I don't have Indian money. I'm sitting on the global side, and I will, in the short term, go overweight on US for the time being, because with the current politics that is emanating from USA and the way they are going, they will continue to see the flows, even if it is actually arm twisted flows. So that is how I'll go around.
And any numbers you can put to it?
Well, of course, you will take a distribution, so maybe 20% in India, 40 odd percent in US, and then distributed around emerging and developed markets. The rest of it, maybe in Japan is not the greatest, but some in Europe.
Saurabh?
So there's two ways to think about India. So let's start with the optimistic way of thinking about India, which is you look at share prices. If you look at share prices, we are a very attractive market. Over the last 5, 10, 15, 20 years, there's only one big market. There's only one big market which is done better than India, which is the United States, right? So America over the last 10 years would be around 13, 14% in dollars. India over the last 10 years would be roughly around 10%. And by the way, over 10 and 20 years, India and America are the only big markets to give you double-digit dollar compounding, right? So in that scheme of the world, in that frame of the world, India and America, I think, deserve equal weightage in your portfolio. So that's the positive way to think about India. But there's a different way, which as a fundamentally oriented investor, I keep reminding myself and my colleagues, which is to look at earnings growth. On earnings growth, the news isn't so good, folks, and this is why I think Anantarayanji was right to highlight valuations. So in earnings growth over 5, 10, 15, 20 years, India does around 5% in dollars, right? If we are lucky, we do 5.5%. Typical decade, India will grow earnings at 5% in dollars. Just to put that in context, forget the NASDAQ. NASDAQ is through the roof on earnings growth. Even mid-caps, small and mid-caps in America do 11% EPS growth over 15, 20 years. The S&P 500 does around 10% dollar EPS growth. So America grows earnings twice as fast. Now, America growing earnings twice as fast shouldn't surprise a lot of people.
Sorry, when you say India, you mean the Nifty, or you mean?
If you take BSE small cap, it's even worse actually. So Nifty 50 EPS growth, dollar EPS growth, 5, 10, 15, 20 years, roughly around 5.5%. Americans mid cap around 11, NASDAQ around 14 actually, but S&P 500, let's take steady S&P 500 around the 9-10% mark. But the remarkable thing is even markets like Japan and Germany, economies that we think of as sedate economies, right? Japan and Germany, they don't sort of evoke dynamic capitalism. Even they tend to do 6 or 7%, right? So over time, right, the message I have sort of taken away, and one of the reasons we worked very hard with our hosts today, with the GIFT City regulator, to set up a global fund. One of the lessons I've taken away is, if you want to build a portfolio which compounds at say mid-teens in dollars steadily, you're better off diversifying. So I'm in, I think, the same boat that Vineet is, which is diversify globally. We suggest to people do half and half of your public equities portfolio in India, half outside India. That half that is outside India, we actually would only do half in America. We do the rest of it in places like Canada, Sweden, Germany, Japan, Taiwan, where you actually get very good earnings growth for PE multiples, which we last saw in India in 2009 or 10. So for example, in small and mid caps in Europe and America, you can very easily get 15% dollar EPS growth for 15 PE. Last time we saw that in India, as I said, is the aftermath of Lehman Brothers.
So, Anil, I think you guys got 2 private market guys and 2 public market guys intentionally. So firstly, thanks for doing that. It's very balancing. Coming right after Saurabh, I think I'm going to comment less about how the multiples and the earnings growth is going to be. I'm going to talk about 2 or 3 vectors in which I think someone like me would look at this. I would have been looking at just consumption and innovation. I would have been long on India like the US, just like Saurabh started. I think we are pretty much the only market after the US, or alongside US, which has had both these cylinders of the economy firing. We are long innovation, we're long consumption. Just take 1.4 billion people, add $2,000 per capita earnings and spending more in India, you get $2 trillion. So when we talk about getting to be a 5 trillion economy, it's no big deal. So being long on India alongside being long on the US is easy. It's honestly not a big deal. But then when you add to it a couple more things like AI, and I think no one in this room can ignore AI. We can talk about it being a pop. We can talk about it being a bubble. We can talk about how much the impact will be, how the earnings effect will be. But, let's face it. It's here to stay. It's here to create an impact. It'll change worlds in ways in which when that alien is visiting, he's going to see a completely different world order. So I think considering that, China is just remarkable. I deal a lot with these guys just as a learner. And what shocks me is that when Jensen Huang said to Trump that deny them the Blackwell chip and you give them 18 months to get there, and you allow them the Blackwell chip and you give them 36 months to get there, that tells you how a country is evolving. So I am an absolute fan of that country, as unpopular as it might be in this room, but I'm an absolute fan of that country. I'm also a fan because I think the world is changing from, we benefited with digital. I think digital has changed in its fabric. Digital used to be something that could be done anywhere. Now digital is firmware. It happens inside the chips. The chips are manufactured somewhere. They're fabless plants. They're, everything has started becoming as much as digital, as much as physical. Power supplies, computing grids, cloud, everything. So I think China just has a remarkable headway when you look at from that headset. The last thing I have to talk about is, and not because you're here, Anand, but because I truly think about it, the only one thing standing against China is its opacity and its regulation. I think we have a huge advantage there. So I think when I look at all these three things, I can't talk about Europe much, so Andrew, sorry about that. I am not a big fan. But I would pick these three countries and I would just place them right on the top in whatever allocation that Saurabh and Andrew can figure out, but those will be my three favorites.
All right. So let me just continue with that theme. In terms of cutting edge sectors, EV and AI, does India have any of that or enough of that? Saurabh, can we start with you?
Sure. So look, given where we are on our cost to capital curve, right? So cost to capital in India, whilst equity cost to capital has come down because of the stock market boom that Anant was highlighting, working capital costs still remain very high. So working capital costs in India are 9, 10, 11%. China, Vietnam will be 3 or 4%, right? Given that we are still a high cost to capital country, it's not evident to me that we are geared to produce cutting edge AI or EV or biotech technology. It's just too big an ask to tell even a listed company, tell an Infosys or a TCS, why don't you guys blast a couple of $1 billion on all LLMs? Because if it doesn't work out, we as shareholders will start bleating about it, right? So what we were doing well, right, and I think we were doing it particularly well before COVID. I'm a little worried about the post-COVID world. What we were doing really well was we were taking cutting-edge technology and adapting it beautifully to India. I think that's partly, I think, what we were discussing here. We were taking, for example, Microsoft's AI, Bajaj Finance was adapting it to Indian circumstances really well. I think they continue to do so. I think that's what we need to keep our eyes on, right? This whole notion that we will tomorrow create LLM. Why? Because, well, China created DeepSeek. Why can't we do it? They see DeepSeek, right? I think that's a bit deluded. So for countries which are far from the technology frontier, we are far from the technology frontier. If we just keep adapting Western technology, Chinese technology, Japanese technology, we can juice up our GDP growth comfortably for the next decade before trying to spend mega bucks on cutting edge foundational IP. And I think that's where perhaps a little bit of a nuanced debate would help, rather than, powerful people, berating our entrepreneurs saying, why do you guys create pizza delivery technology, right? I don't think that sort of reprimand is worth it. It makes sense for Indian companies to take global tech, adapt it to India and create shareholder wealth.
Sounds a bit like Bollywood movies also, right?
Yeah, I think Bollywood movies using AI would be a good way to take American LLMs and adapt it to Desi purposes.
It's happening, by the way.
I'm sure. Yeah.
Any views on this, Vineet?
So, slightly different. AI is not new to India. People have been actually working on Indian languages. So, on conversational AI, India is a very crowded market. Actually, it's not a market that's actually behind. If you just take conversational AI and put Google and Microsoft's agentic AI and compare them to the Indian ones, on Indian languages, the performance of Google and Microsoft is really poor. So those LLMs don't work. You need to create the SLMs here, and those SLMs are performing way better. On English, they are competing with, of course, Indian language has its own accent. So
can you give us some examples?
I'm actually investing into a company, therefore I don't want to actually talk about it. But I have just gone through that. I've gone through the numbers, I've gone through comparisons across the different languages. The 14 Indian languages, there is absolutely zero comparison between the capabilities that have been, especially the deep AI companies that have SLMs of their own. And it's an expensive way to, even LLM is very expensive, but even SLM is quite expensive, takes time, and you have to literally pay money for people to talk to you so that you can pick accents. So it's expensive activity. On the Indian side, we beat Google and others by a very long distance for a reason that they don't have that kind of depth on the language. So I do personally see that the kind of innovations taking place on the deep tech frontier at a very early stage are challenged, but what government has done with the RDI fund, that's actually quite unique. I don't know how many of you know about the RDI fund. It's a 1 lakh crore capital that has come from Government of India. And the interesting part is the 20,000 crore, which is going towards the AIF ecosystem, has actually come with a very different, so it's not coming, so while it's coming from government, everybody is scared about taking government money and then having a CAG audit chasing you. They have come up with the new financial guidelines, so therefore this money sits outside. This money has been handed over to the department for 50 years, and so it could be rolled over for 2-3 years. So that 1 lakh crore can be rolled over multiple times, and that kind of infusion of capital has never happened across the globe.
How do they pick AIFs? What's the criteria?
Their criteria is you should actually invest the capital into deep tech, but the way they have defined deep tech and deep science allows you to go into application of tech, including going into deep tech. So it's a fairly wide, not prescriptive, but just to give you an idea, assembling of a battery versus working on battery chemistry, their preference will be battery chemistry, but they're not against you assembling a battery. So just to give you the variety that is there. So I personally think India has a potential play, a significant play. We will not play the way the Americans and the Chinese are playing. We'll play differently. It will be, there is a small company, in 2009, I provided a 10 lakh rupee grant to a small company called Unifor. In IIT Madras, Umesh Sachdeva made a small presentation to us, and without understanding what he will do, we gave him a 10 lakh rupee grant. Today it's a $3 billion company, largely focused on US, and I couldn't invest into him because he actually pivoted towards US markets. But Unifor actually is a good example of what can come out from India and scale up. It's very difficult for Indian companies now to catch the US markets. It's very crowded and very competitive, so we can't catch it. But it has already happened, so it's not that it's not happened.
Andrew, your view on, if not AI, what sectors will drive India?
No, just on AI, it's a missed opportunity as far as I'm concerned. We're going to be a taker again of something we shouldn't have been a taker of. I can understand maybe manufacturing, which we've not been a big manufacturer in the past, and we're trying to catch up now with semiconductor. But we're late. We're very, very late. But in AI, I don't know why we're late. Our IT companies, we're at the forefront of speaking with all of these companies globally, particularly in the US. So instead of spending money or giving shareholder money back, surely they could have used this to look at some AI companies or AI kind of related companies in the US or elsewhere, which would, I'm sure the valuations now would be sky high. So I'm not quite understanding why we didn't take that opportunity. And now we're saying, okay, it's okay to be a taker. Why are we a taker? We shouldn't be a taker. Given all the talent we have in India, why are we a taker of this? So I'm disappointed that we didn't take this opportunity. So we might put a nice kind of rosier view on what's going to happen going forward, but the opportunity's been missed as far as I'm concerned. I'm not saying we won't do well, but we missed the big opportunity.
So just quickly, I think Andrew raises a very interesting question. There's a book that was published last month, a guy called Carl Benedict Frey, he's an Oxford professor. The book is called How Progress Ends. It's got, in a way, the parts of the answer to this question, right? What the question Andrew raises, I think, is a central question we should ask ourselves as Indians. And read this book, Carl Benedict Frey, How Progress Ends, outstanding book on why China got onto the right bus and why some of the key buses that left in the 21st century, we missed the bus. How Progress Ends by Carl Benedict Frey.
I go next? I'm actually going to pick that up. I really think, Andrew, it's the cobbler's shoe issue, right? We were doing it so well with IT. IT was supposed to be the ground on which you would have created AI. And naturally, it was cannibalizing your own business because IT would have been the very ground that would have hit first.
Innovator's dilemma, basically.
Absolutely innovator's dilemma. And I think somewhere between what Vineet and you were saying also lies the solution. I don't think we will just lock ourselves down to the deep science of that, but rather the application of that. And I was with Dr. Jitendra Prasad, the minister, yesterday for science and technology. It was only around the RDI fund, and I loved the flexibility they talked about. So somebody exactly asked that question in that group with him. It was funds like us. And somebody asked the question that how restrictive would you be? He says, pretty much like Anand, you were saying. He said, pretty much as long as you're good guys, I would not test the limits. I would let you be flexible with the limits, be creative with the limits. We want this capital to get leveraged, to get deployed, to get used, and to get recycled. So I think the government is coming with a great headset. I still don't think we'll catch up. So I'm where you are. I don't think we'll catch up on the deep science part of it. But I truly think there are things on the AI application side where we will become unbeatable. Entertainment, you were talking about Bollywood. I want to take an example really since you guys talked about it. We just looked at a company and ended up investing in it. They end up producing 200 shows a month at an average cost of 16 lakh rupees a show. And it happens because of AI. Other than the human shoot, which is 1/5 of the total process cycle, from audio to script to screenplay is all AI. Post-shoot, the VFX and the post-production effects is all AI. So
Can you tell us the name?
Well, there are many. I don't want to evangelize since we are vested into it. I can happily share it separately. I don't want to run advertising for them. But yeah, fantastic company. It's everyone from Google, YouTube to Geo. We are in their facility. Everyone's knocking on their doors. Everyone's figured out, and they're just going gangbusters on it. So I think it's a great example. Biopharma is a great example. Nobody has got better molecular research than we do on the planet. We do. The reason we are not able to take our molecular research all the way and assert patents is because it's just very expensive. That's where AI comes in. We're going to play out what with Merck and with Eli Lilly and with Pfizer we couldn't do, we'll do it now. So I think coming back to that original question you started with, the countries, I think AI, we miss the core science part of it, but we won't miss the application side of it.
Since Anand is here, let me just quickly segue to a regulatory question or a consumer one. Today as a consumer, if I want to pick an AIF, there is no way for me to compare returns, portfolios, anything, unlike a mutual fund. And that's been predicated on this whole principle that it's a private placement and so we can't display this in public. But what is the harm exactly? I mean, I don't understand. Why not at least show some limited, maybe portfolio with a lag or at least returns up to the last financial year, something that enables me as a consumer to make this comparison. If we can just, Saurabh.
I think, I've been put on a SEBI committee which is deliberating exactly this, and whilst I don't think there's any harm, the reservations, and it's a minority view, the reservations such as they are is that, well, I agreed to make Neil and say Andrew my LPs. I didn't agree to make Anant an LP. How can he just suddenly come out of nowhere, buy units in my fund from Neil, and tomorrow morning I'm beholden to Anant, right? That's where the minority view is. It's a private market. I sort of let you guys in because I like you guys. It doesn't mean every single Tom, Dick and Harry can come and buy units, right? That's the minority view. The majority view is along the lines of what you're saying. Let's create transparency. Let's create a space where people can buy and sell units. And there's at least transparency that Anant and Neil transacted in units in Saurabh's AIF at such and such price.
Sure, I mean, transaction is one part, but information that I can make an informed decision.
So in the private markets, you are valuing, right? And valuation actually is beauty lies in the eye of the beholder, especially if it is in a private context. Now you are valuing yourself every year, and there is capital going into certain. So right now, if you have invested in AI, you could be $22 billion today and zero tomorrow. So how do you actually compare across funds? So, and I think there is a lot of lack of understanding around AIFs being invested because you believe numbers. 50% of the credibility worldwide for a fund or a fund manager is the credibility of the fund manager. because you can misuse the money in many different ways. There is too much power that is devolved to the fund manager. So if you go to an IFC which has 200 funds, or a BI, or to anybody, most of my LPs, a significant amount of their capital or their reputational risk is on judging whether they can trust the fund manager. Abraj is a great example. It was the fastest growing Asian fund manager. What happened? Not because you can make mistakes in many different ways, not just by generating returns. And that's where the public markets and private markets are very different. So you cannot compare it simply by actually looking at the numbers, because those numbers can completely mislead you. And so anybody who had Baiju in their portfolio will look like a rock star, and then you invest there, and then who are you going to complain against that? And somebody who was actually delivering an 8% return may look like a completely shit company, but might become 16% next year because those. So I think it's a very dangerous thing in private space to start looking for those comparisons, because it's not. So in a public markets, you can actually see through cycles. In private markets, very difficult, because we are ultimately limited life funds. They exist. You may actually exit in good times, or you may invest in good times, exit in bad times. You will look like a very bad fund manager. So it's not that easy, and therefore you have to be very specialized to participate. And so one question that you have been asking, I have been actually continuously making this to SEBI on the accredited investor. Why can't I, if I have the capability, give that self-certification that I am capable to manage my money? And should not that be acceptable? Because when the accredited norms came, one of the biggest challenges, most of these people don't want to go to a chartered accountant, get the certificate. That's the biggest problem, both for Indian individual investors as well as large number of investors outside. Of course, one can then look at what happens in Singapore and look at but so self-certification probably will take care of this, because then somebody is certifying, saying, I don't need SEBI's protection, I'm mature enough to do it. Unfortunately, some of those 80 years old might also still do it. So that's the risk that we carry. But a self-certification might be a good solution for the accredited fund.
Andrew, on this disclosure point, would you agree at least for Cat 3 there should be display of returns, portfolios, because it's basically public markets?
No, I would agree, because you had a lot of funds which were, say, PMS funds, because it's easier to kind of pool money together in Cat 3 as long-only funds. Now, if you're a long-only fund, then you should be compared against something. So, it's in public equity markets. You should be able to kind of compare with a mutual fund, and whether you're long-only in terms of are you actually long-only in terms of large cap, mid cap, small. So I think that's one of the things which I think investors should know about in terms of the hedge fund type of funds as well. I don't see any reason why they can't disclose what they have. I mean, we had a monthly newsletter which gave exactly the NAV, exactly the holdings of to the investors. So why can't that be made available? I mean, it might change a little bit quicker on a hedge fund than it would do on a pure long only, but I don't see that can't be available.
All right, we have maybe a couple of minutes more. So Andrew, I'm just going to quickly ask you, there is an argument that past few years in this bullish market, essentially promoters have been cashing out, public has been buying in, signaling something. Would you broadly agree with it? With IPOs, a lot of overpriced IPOs seem to be coming to the market. Is that also reflective of this argument?
It seems that the bigger the loss you make, the better valuation you get. I remember the argument being that why show a small profit? You'll get a valuation, a PE valuation. Therefore, you don't actually get the pop and the premium. So I think that's where the market is. We're at a point where valuations are there. They're a bit better than they were 6 months ago. But I think we're all if we have any kind of market fall, I think we'll all wake up with a lot of those IPOs being hugely underwater. Hugely.
All right, Saurabh, last word to you on this.
So look, I think Anand highlighted it. What's happening is the rupee will make up for the lack of domestic market valuation, right? So as private equity, as the MNCs in cash and take their money out of the country, we are seeing something that we hadn't seen for the last 20 years, which is we're seeing a capital account deficit. India used to see a current account deficit, and a capital account surplus, and therefore the balance of payments would roughly balance. Now, since everybody who's got a sort of a heartbeat is saying, let me encash and take the money out of the country, we've got current account deficit and capital account deficit. Naturally, the rupee will keep depreciating, and effectively in dollar terms, the rupee depreciation at some stage will take care of the overvaluation that's prevalent, especially in small and mid cap. I agree with Andrew that things are slightly better than they were 6 months ago on small and mid cap valuation.
Hang on, so that's bad news for us, right? All of us in this room who have rupee,
No,
predominantly
which is why invest in dollars, right? I mean, the free market.
He's selling his
right?
fund right
So everybody, the whole world can see the valuations here are not making sense. Koreans are encashing, the British are encashing, the Americans are encashing, and therefore the capital account surplus used to be capital account surplus has become a capital account deficit. I think it will stay a deficit until valuations reach sanity, because as my friends in private equity say, if you wake up in Mumbai these days, you sell as much as you can and you exit as much as you can, because the market is giving you silly valuations to encash and take money out of the country.
Fantastic. All right. On that note, we have to strictly adhere to the time, so I'm going to have to close.
Just one last. I personally don't believe markets are silly. Markets are very intelligent. We may disagree with the valuations, but you cannot disrespect the market. So we have to give it the respect that it deserves. We may disagree with it. It's a different matter.
All right. Thank you so much, everyone.
Thank you. Thank you.
Thank you so much to all our esteemed panelists for such a grounded and insight-rich discussion on how capital is actually being deployed in this divergent environment. Can you please, I'd like to call Mr. Senthil G, Chief Business Development Officer, KFin Technologies, to present the speaker gifts as a token of our appreciation.